Imagine you're a real estate agent specializing in high-end properties nestled along a picturesque seaside location. Lately, you've been facing a challenge. While you still enjoy a comfortable income, a substantial number of prospects ultimately decide against purchasing properties through your agency. Frustrated by this situation, you are determined to find a solution to not just sustain but boost your business. So today, I'll take you to how business owners save big with deductions. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. To comprehend the significance of tax deductions, let's start with the basics of taxes. As a self-employed real estate agent or a small business owner, your income is generated from the sale of services or products. This total income is subjected to taxation, but the exact amount varies based on your earnings, with higher incomes incurring higher tax rates, ranging from 10% to 37% or more, depending on your country of residence. Tax deductions or write-offs offer a powerful mechanism for reducing the taxable income that you must report to the government. Essentially, they lower your total income, which subsequently lowers your tax liability. These deductions can encompass a wide range of business expenses, and the key is to leverage them strategically to maximize your tax savings. Before we dive into the specifics of tax deductions, it's essential to recognize that taxes in the United States can be quite complex. In addition to federal income tax, many states impose their own income taxes, which can significantly impact your overall tax burden. For instance, imagine the allure of living in California with its iconic Hollywood, vibrant skateboard culture, stunning beaches, and seemingly endless sunny days. However, there's a catch: the state tax rate of a staggering 13%. If you're self-employed, you face an additional self-employment tax of 15.3%. Moreover, you must contend with sales tax, property tax, social security tax, and even gift tax. The list seems never-ending, but there's a way to legally minimize your tax liability and keep more of your hard-earned money: tax deductions. Tax deductions operate on a straightforward principle. They reduce your taxable income, ultimately lowering your tax liability. To illustrate this concept, let's examine a practical example. Suppose you own a bakery and a customer pays you $1,000 for a delectable cake. The government typically imposes a tax rate of 30% of your income, resulting in a $300 tax bill. However, your cake didn't materialize out of thin air. You had to purchase flour, eggs, sugar, and packaging materials to craft the final product, incurring expenses totaling $20. As a small business owner, you can deduct these expenses from your total income. Here's where the magic of tax deductions comes into play. Instead of paying taxes on the entire $1,000, you now pay tax on the $1,000 minus the $20 in deductible expenses, amounting to $980. With the same 30% tax rate, your tax liability reduces to $294, saving you $6. This straightforward concept, when applied to various business expenses like ovens, rent, and operational costs, can lead to substantial tax savings, potentially thousands of dollars per year. Remarkably, many taxpayers remain unaware of the vast opportunities tax deductions offer. In the United States alone, over 2 million taxpayers overpay their taxes every year, unknowingly leaving money on the table that they could legally keep. This unfortunate reality stems from a lack of understanding of how tax deductions work and which expenses qualify for deductions. To harness the full potential of tax deductions, it's crucial to distinguish between business and personal expenses. In this regard, let's meet two fictional real estate agents, Tom and Jimmy, who operate in the same market but possess contrasting approaches to deductions. Tom, an enterprising individual with a taste for risk, is eager to capitalize on tax deductions. He seeks advice from his certified public accountant or CPA, the professional who manages his taxes. Tom's enthusiasm leads him to explore deductions for a wide array of expenses, including personal ones like a new jacuzzi, he claims helps him focus on his job. Jimmy, on the other hand, is cautious and hesitant to deduct any expenses, fearing potential legal consequences or an IRS audit. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love, so we can help more people thrive wisely. And going back, Tom and Jimmy approach their CPA, each with different perspectives on tax deductions. Their CPA, well versed in tax regulations, guides them towards legitimate deductions. So let's look at a few examples that might help you understand this better. Example 1. Business travels. Both Tom and Jimmy plan to attend a 3-day business conference in the Canary Islands, a vital event in their real estate careers. They inquire about the deductibility of expenses associated with the trip, including travel and lodging. The CPA confirms that they can deduct the cost of traveling to and from the Canary Islands for the conference. Additionally, they can deduct all lodging expenses incurred during the 3 days of the event. However, Tom inquires whether he can extend his stay for 3 more days, captivated by the beauty of the Canary Islands. The CPA clarifies that while expenses related to the 3-day conference are deductible, any additional personal expenses incurred during the extended stay cannot be deducted. Example number 2, home office deduction. Tom and Jimmy, as cost-conscious business owners, decide to work from home to save money. The question that arises is whether they can deduct any expenses associated with their home office. Jimmy expresses skepticism, believing that personal expenses cannot be deducted. However, Tom is more optimistic and inquires about deducting mortgage payments, utilities, Wi-Fi, insurance, and even repairs related to his home office. Tom is in for a pleasant surprise as his CPA explains that he can indeed deduct these house-related expenses. However, there's a catch. Tom doesn't work around the clock in his house. He also resides there for personal purposes. The solution is to deduct a portion of these expenses. For instance, if Tom lives in a 1,000 square foot house and his home office occupies 200 square feet, the IRS allows him to deduct 20% of the total house expenses. And then example number 3, business mileage deduction. One area where many business owners, especially those with a cautious approach like Jimmy, often miss out on substantial savings is the business mileage deduction. Suppose you have to travel 30 miles to attend a meeting with a new client. In 2021, you can deduct up to 56 cents for every mile driven for business purposes. Jimmy raises the concern of tracking all of these miles for business purposes. The CPA reassures Jimmy that keeping an accurate record of business expenses is essential. It's recommended to meticulously record expenses daily, including details of public transportation, trains, taxis, and more. Tom adds that it's a good practice to have a notepad in the car to document initial and final mileage for each trip. This level of diligence ensures that not a single dollar is left on the table for the IRS. While we've covered some vital examples, there are numerous other expenses you can deduct from your taxes. These deductions operate on the same principle. They must be ordinary and necessary for your business. Ordinary signifies that these expenses are common in almost all businesses, such as meals, supplies, travel, and advertising. Necessary is a bit more nuanced, as it varies depending on the specific needs of your business. Consider the example of a bakery, where flour, eggs, and other supplies are deemed necessary because they are essential for baking cakes. The purchase of office supplies like paper, pens, and technology for your business also qualifies for deductions. This extends to expenses related to computers, cell phones, and cell phone services. However, it's essential to calculate the portion of time these resources are used for business versus personal purposes. Tax deductions are a powerful tool when used creatively and responsibly. They can help you reduce your tax burden while maintaining compliance with the law. Take for instance the story of the real estate agent who purchased a yacht and successfully deducted it from his taxes. This seemingly extravagant purchase was both an ordinary and necessary expense, serving as an advertising investment and a compelling tool to impress clients and persuade them to invest in high-end beachfront properties. In conclusion, tax deductions represent a valuable resource that can help business owners legally save money and optimize their finances. By understanding the tax code, distinguishing between business and personal expenses, and seeking advice from tax and financial advisors, you can become a savvy taxpayer who maximizes deductions without leaving money on the table. It's crucial to note that the information provided in this guide is for educational purposes and should not replace legal and accounting advice. Rather, it serves as a starting point to empower you with knowledge about the tax deductions available to business owners. By being informed and prudent in your financial strategies, you can unlock the full potential of tax deductions, ensuring that your hard-earned money remains where it belongs, in your pocket. Well, that's basically how business owners save big with deductions. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.